Robert Brown, Chief Investment Officer of Northern Trust, based in Chicago, where he oversees more than $758 billion in assets. And while he may have the Midas touch when it comes to investing, in terms of tactical positioning, he's just recently eliminated his position in gold. Bob's here in New York for Bloomberg Exclusive. And is this about gold, or is this about the overall environment with stocks surging to record high? Just get into those risky assets.
Well, it's more about the latter. It's not so much that we're negative on gold, it's just that it no longer serves the purpose of being a hedge against a variety of risk scenarios. Our base case is that it's a good environment for risk assets overall. We're overweight U.S. equities, we're overweight high yield, emerging markets, and we wanted to put some money more specifically into an inflation hedge by buying TIPS and also putting money into natural resource equities, which we thought would be better for the long run.
Why are TIPS a better hedge against inflation than gold in your view?
Well, gold, if you look at it historically, the correlation with inflation has been iffy at best. That's a technical term. Where short-dated TIPS have a much better correlation against inflation protection, and so that's our focus. Gold is a good hedge against a mistake by the central bank, lack of confidence in the financial system, and we just don't think that hedge is as justified now as it had been a few years ago.
We're looking at some of the factors driving this rally. For you, is a lot of it the Federal Reserve and all of the stimulus, or is it the fundamental underlying economy?
Well, it's both, and people who say this is a bubble-based rally simply dependent upon the Fed, I think, are missing the point that we are now at record earnings. We have surpassed the peak in earnings from the S&P 500 back in 2006. Rates are lower, so the accommodative policy is also without doubt supportive. And the economy is growing. The largest economy in the world is growing moderately but on a sustained basis, and that's a key point for us.
So let's talk about a world in which there is inflation again. So you have some protection in the form of TIPS, but you've got equities and you've got hard assets, as you were saying, or at least a play on hard assets through your natural resources stocks. But what about high-yielding securities? Why would you want to own? I mean, do you own bonds?
We are underweight investment-grade bonds in our global asset allocation portfolios. We are overweight high-yield bonds. And so that duration sensitivity is something we are watching out for. But with the Fed on hold and inflation, while generating negative real rates, is still moderately behaved, and investors are willing to give the market a pass for now for earning a negative real return. When we can invest globally, we prefer to be elsewhere. In our bond-only portfolios, we continue to think rates will be relatively well behaved.
Do you see a point at which you will be shifting out of fixed income more aggressively than you have and being underweight across the board?
Well, we're already pretty underweight. We're underweight about 10%, and we think that's a comfortable underweight for us in a global asset allocation portfolio. Rates, we think, will be negative on a real basis for at least a couple of years.